Hello, Pathfinder community. Thank you for attending today's webinar. Today we'll be talking about the complex topic of employee stock compensation plans, specifically stock options and restricted stock. First, let me introduce myself. My name is John Zachary. I'm a wealth advisor and certified financial planner with Pathfinder Wealth Consulting. Here at Pathfinder, one of our core values is educating our clients. One way we've done this over the past year is to create a back to basics video series where we take complex issues and bring them down to a basic level of understanding.
All right, so let's get into it. So as far as the agenda for today, stock compensation is a pretty large genre. Today we're going to focus on two particular areas. So first we'll start with stock options and then go to restricted stock units, and then we'll wrap it up with some key points and some take homes for consideration with your own personal situation. Over the course of the last several years, we've seen more and more companies turning to stock compensation as a way to attract, retain, and really compensate employees. From local companies here, Live Oak Bank and Encino, to name a couple, to large national companies like Amazon or Red Hat, which is now with IBM. We're seeing the compensation from through company stock as a way to supplement salaries, and it makes sense for companies to do this. For one, it gives less out-of-pocket expense for direct salaries. They also give the benefit of having employees participate in company stock, and for retention purposes, employees can see the benefits of their hard labor. So, hopefully increasing stock price. So the idea is that maybe employees might work harder because they now get to participate in the growth of the company through the stock. All right, so first for stock options. So stock options are a form of compensation, as I mentioned, used to augment salaries or to attract talent in lieu of traditional salaries. So more specifically, a stock option is a company benefit that gives an employee the option to purchase shares of company stock at a predetermined price over a predetermined vesting period. So for the purposes of the conversation today, we're going to refer to that predetermined price as the grant price. So once you're vested in a stock option, you as an employee, you can then exercise that option and then purchase the company stock for that predetermined grant price without regard to the current fair market value of the shares. So a grant price can also be referred to as a strike price or exercise price, but for the purposes of today, we'll be referring to it as a grant price. And just a quick note on vesting periods. Vesting periods can be time bound or based on metrics of the company. So it's sometimes called PSUs, and with the restricted stock units or performance stock units, they are tied to specific metrics with the company. So EBITDA or profitability of the company is a common one that you might be awarded a certain number of shares, but whether you get all those shares when they vest is based on some of these corporate metrics. For the purposes of today, we're going to just to simplify this a little bit. We're going to talk more about time-bound vesting, which is where these awards vest over a certain number of years, just to play out some scenarios so you can see how they work. So just to kind of digging deeper into stock options, there's two types of stock options: incentive stock options, which we're going to call ISOs, and non-qualified stock options, which NSOs is what we'll call those. There's a minute difference between the two in terms of how they are taxed. So with ISOs, there's no taxable income. Actually, with both of them, there's no taxable income when these things are awarded or when they're granted. So with ISOs or the NSOs, you're not going to realize any taxable income when you get these awards. With ISOs in particular, there's also no ordinary income tax or capital gains tax when you exercise an incentive stock option. There are some particular rules to be able to qualify for that preferential tax treatment. So there you see that if The shares must be sold later than 2 years from the grant date. And then also there's vesting requirements and things like that. Also with incentive stock options, there's potential AMT implications. I'm not going to talk a lot about that today. With the most recent changes in tax legislation, AMT got pushed up to a higher exemption. And so it is rare that folks fall into that. But if you fall into that category, certainly come talk to us and we can help figure out, what kind of implications that could have. So on the other hand, with NSOs, they are taxed when you exercise. So we'll go into some examples of the differences between both of these. But with an NSO, when you exercise the option, you're taxed just like ordinary income. So just like your normal salary or wages, based on the difference between the grant price and the market value of the stock when you exercise. So, compared to ISOs, NSOs do not have any restrictions on selling after you exercise, although capital gains tax may apply, which we'll talk about. In general, incentive stock options or ISOs are only awarded to top management and highly valued employees. So they can also be called statutory or qualified stock options. I come across the non-qualified stock options more commonly than ISOs. ISOs are a little more rare. All right, so let's jump into some examples. First, with kind of our base case here, we're going to run through a scenario of an employee that gets a stock option grant of 1,000 shares of company stock. In this scenario, the grant price is $15 per share. And the vesting period is 25% each year over 4 years. So after 4 years, they'll be fully vested, and those 1,000 shares will be available to exercise. The expiration, which is standard, a 10-year period from the grant date. So fast forward 1 year from when those shares are granted, an employee will have 250 vested stock options that they then have the potential to exercise. So the key with stock options is that if the stock price is below the grant price, when you have these vested shares, the options are considered out of the money. So they're essentially worthless to you at that point. They become valuable once the stock price goes above the grant price. In this case, we call these in the money. So in the money, out of the money. In the money, you're able to exercise this option for a profit. The difference between the market price and the grant price, we call the intrinsic value. So quick note on the expiration. If the stock option stays out of the money, so if the market value of the stock stays below the grant price for that 10-year period, it is possible that stock options can expire worthless. So stock options really might have some intrinsic value, but you really don't get the value until you exercise the options. So, also if you leave a company, your stock options may be forfeited upon termination. So those are important things that you want to read in these agreements to see what some of those terms are. Running through a scenario here. So let's assume the stock price is at $20 a share when the first round of shares vest. So after that first year, when you have 250 shares, the stock price is up to $20 per share. If you decide to exercise the stock options at that point in time, you would purchase the shares at the grant price. So you purchase 250 shares at $15 a share. So you're fronting $3,750. And then in return, you receive those 250 shares worth the current market price of $5,000. So $20 per share times 250. So you're realizing a profit of $250. So what a lot of people see when they see stock options is they see that, what they're worth, which is the $5,000 based on the current stock price. Well, a lot of people don't realize that you have to front the money because you have the option to purchase these shares at that grant price. So the profit that you realize is really only $1,250, not the full $5,000. If an employee doesn't have that $3,750 to purchase the shares, or may have it and they don't want to use it for this purpose, there's something called a cashless exercise that some financial institutions will let you do. This is where you borrow the upfront cash flow, was in this case $3,750 to purchase the shares, and then you immediately sell enough shares to repay the money borrowed, netting that difference of $1,250 worth of company stock. All right, so let's talk about some of the tax implications of this. So with this example here, we haven't indicated yet whether it's a ISO or NSO. First, we're going to look at the NSO example. So as I mentioned before, with the NSO, you're taxed on the difference between the grant price and the market price. That's your profit. So in this example, the employee would have to pay ordinary income tax on $1,250, the profit. And then going forward, the employee's cost basis is then $5,000 or the $20 per share, which is the current market price. So ordinary income tax is, again, whatever your marginal tax rate is for your household. So if you're married, it takes your spouse's income when the IRS has those tax rate schedules, and that's what's going to determine what the tax is. So I can't give you an estimate what that would be. It'd be based on the individual. So but that happens immediately upon exercise, is when basically that taxable income has been received, and then that goes on that year's tax returns. Now, going forward, so if the employee decides to hold on to the stock, going forward, another tax may apply, and that's called capital gains tax. So we'll expand on this a little more. So keep in mind here, so that the cost basis in the stock going forward is $5,000. So capital gains tax is paid when you sell an asset for more than you paid for it. So basically, when you sell it for above what your cost is, or your cost basis. If you hold an asset for less than 1 year, short-term capital gains tax applies. If you hold it for 1 year or longer, long-term capital gains tax applies. The short-term capital gains rate is essentially equal to your ordinary income tax rate, which we just talked about. The long-term tax rate, and this is a preferential treatment here, the long-term capital gains tax rate is still based on your income. That's generally 15% for most folks. So these numbers can change annually, but for 2020, if you're a single taxpayer, once your income goes above $441,000, you jump up to the 20% long-term capital gains rate. And if you're married, it's $496,000 in income when you're before your long-term capital gains rate jumps up to 20% from 15%. So that's why I say most people fall into the 15%. Now, if you're below a certain income, your long-term capital gains tax rate is actually 0. So for a single tax payer, if your income is below $40,000, you actually have a 0% long-term capital gains rate. If you're married, that number is $80,000. So for those in that scenario, as long as you hold it for 1 year, you're going to get the most bang for your buck, because you're not going to pay any capital gains tax on any sales if you sell it at a gain. So that leads me to my next point. So capital gains tax, of course, only applies if you have a gain. If the stock price goes down after you exercise, you will realize a capital loss if you sell. So you can use these losses to offset other gains, or, as noted here, reduce your income on your tax return. So the IRS allows you to use any tax losses that you take from these capital losses, and you could use up to $3,000 per year to reduce your income until that pool of losses is used up. So that's a neat little rule that the IRS gives us. But say for this example, if the stock price grew to $30 per share and the employee sold all of their 250 shares from this first vesting period 1 year or more from the exercise date, there'd be a long-term capital gain of $2,500. So you got that $10 gain from $20 to $30 per share times your 250 shares. So now you pay long-term capital gains tax on $2,500. If kind of the opposite end, if the stock price drops to $10 per share, so from $20 to $10 per share, now you have a loss of $2,500 that you could use all of that to offset any other capital gains that you have for that year, or you could use that $2,500 to reduce your income for that tax year. So now let's talk about the ISO, so the incentive stock options. So again, unlike the NSO, you are not taxed when you exercise, and any future profits are taxed at the capital gains tax rate, not the ordinary income tax rate. So now you have to hold it for a longer period, and so essentially you're holding it past that 1 year time period, and that's why the capital gains tax rate applies, not ordinary income. And these are the rules here. So ISOs, to have that preferential tax treatment, you have to have a vesting period of at least 2 years, and they require a holding period of more than 1 year from the date that you exercise before they could be sold. Otherwise, you don't get that preferential tax treatment, and it could be taxed at your ordinary income tax rates. So that caps off kind of the summary between the two. Here's just a scenario of what that would look like over time. So over that 4 year period, so year zero, of course, you get granted the 1,000 shares at that $15 grant price. At that point, there's really no tangible value for the employee until the end of year one, when the 250 options to purchase vest. So at that point in time, this gives you our first example here, year one. But then you can see it over the course of several years. What this would look like as, each year 250 of the options vest. And then at the end of year four, you've got the full 1,000. So now you don't have to exercise these within this 1 year period. As long as it's within that 10-year expiration period from the grant date, it's fine. So, so in this scenario, if an employee held, even though that they were in the money because the stock price was above the grant price, someone held on to these shares and waited till year four, the end of year four to exercise these, they now have 1,000 shares that they could exercise, quote unquote. So in the year four scenario, if the stock price was at $30 per share, now you'd have to front $15,000 to buy all 1,000 options, 1,000 shares times $15 a share. And then you'd receive in return the 1,000 shares valued at $30,000. So you'd have ordinary income tax in that year of $15,000, which is the profit that you would realize on that exercise. So now, I'll ask you, would you rather realize the taxable income spread out over 4 years or all at once? And I can't answer that question for you. It's based on your individual tax situation. I would, of course, you want to get the most value out of these shares. So if the stock price goes up, you're getting the most value, but you also want to be smart tax wise and making sure you're planning ahead with these and not doing something that's going to cause unwarranted tax liability that you could have avoided by, maybe spreading it out further. Just one comment here that I have here on this chart. So in year three, you'll notice that the stock price actually dropped. So in this hypothetical scenario, the stock price dropped to $15 a share, which I have the same as the grant price. So in that case, the employee wouldn't want to exercise the options because the market price is equal to the grant price and there's really no intrinsic value. So why would you exercise this option when you could just go out to the public market and buy the stock at $15 per share on the open market? So the value really the stock option really has no intrinsic value at that point. So you would want to wait to make sure, to see if you could wait till the stock price appreciates a little bit. All right, so next topic is going to be talking about restricted stock units. So restricted stock units are a lot different than stock options, the way that they're taxed. So we'll walk through the differences and run through a couple examples for these as well. So just going through the baseline, restricted stock units are a form of compensation issued by employer to employee in the form of company shares. Like stock options, RSUs are subject to a vesting period. Once the shares vest, they become fully transferable or no longer restricted. So really what that means is that they become full ownership of the employee at that point in time. So you can't sell a RSU prior to vesting, but once the vesting period is satisfied, then you have the right, you basically own those shares. You could sell them if you want to, or hold on to them. Comment here, similar to RSUs, PSUs, performance stock units, vest according to the company performance metrics, which I talked a little bit about earlier. But again, we're going to use time-bound vesting for the purposes of today with the restricted stock units as well. So using some similar numbers here. So here's an example with RSUs. If an employee gets awarded 1,000 restricted stock units of company stock. So same vesting timeline, so 25% each year over 4 years. So it takes, after the end of year 4, you're fully vested in your 1,000 restricted stock units. So 1 year from the award date, 250 shares of stock will vest. At this point, again, the full ownership is transferred to the employee. And in most cases, what happens is that those 250 shares get deposited into a brokerage account in the employee's name. So now that now it's fully in your name, and you have full rights to buy or sell more or hold on to them for a future date. So one of the big differences between stock options and restricted stock is that stock options can expire worthless. So if you hold stock options for that 10-year period, and as I mentioned, the market price never goes above the grant price, they can expire at no value. RSUs, there should be some value in these restricted stock units as long as the company's stock price doesn't go to zero. Similar to stock options, the vesting period, or the vesting schedule, there are rules based on the different agreements with these that if you were to be terminated, how these are treated. So again, one of those that you want to pay close attention to and really read those agreements to understand how these are structured. One comment about restricted stock units, someone brought this up as a response to the Business Journal article that I wrote on this topic. If you have shares of company stock outside of RSUs and you sell them for a loss and take a tax loss, as I commented on earlier, there's something called a wash sale rule that if you buy any shares back within a 30-day window of selling them for a loss, it's a wash sale, so you don't get to take that loss. RSUs are treated essentially like a purchase for tax purposes. So if an RSU vests in that same 30-day window before or after you sell the loss, it washes out your loss, and you can no longer use that loss for tax purposes. So there's a kind of specific note on that there are a lot of technical details with these. I can't cover all of these in just one webinar, and that's one of those, and shows the importance of really knowing how these work and how they fit into your own situation. So anyway, back to the example here. So as soon as those RSUs vest, in this case, the 250 shares, you're taxed as ordinary income on the total market value of the vested shares at that point in time. So in this case, it's the total market value. So if the stock price was $20 per share at that point in time, you're taxed on the full $5,000 because that's the full benefit that you receive from the RSU award. So you're not having to go out and buy any shares. In this case, you're getting that full award of stock shares. So the $5,000 is taxed. And we'll talk about how that's taxed. And same as the stock option example, the employee's cost basis going forward, then it becomes $5,000 because that's what you're taxed on as that from that award. In most cases, this is how it works. So in most cases, enough shares are sold to cover the tax withholding from the vest date. So very similar to a normal paycheck. And what typically happens is enough shares are sold, and then the remaining shares are deposited into that brokerage account that I mentioned before. So as an example here, if say the employee's tax withholding was 20% of their paycheck. So in this case, 50 shares would be sold. So 20% of 250 would be sold, and the remaining 200 shares are deposited into the employee's brokerage account. So now there are some alternative methods for covering the taxes, where they don't have to sell shares, which, vary plan to plan. And then another, quick note is that you do, similar to your paycheck, you do have to pay FICA taxes on an RSU vest. So that's the Social Security Medicare taxes are also assessed with this income that you get. So it's almost like a lot of times I explain them like a bonus. So, the vesting of an RSU is kind of like you're getting a bonus, and it's taxed very similarly like it would be run through payroll, like a normal bonus through your paycheck. All right. So then once these shares vest, now you have full ownership of them. Now you could sell them immediately, or you could hold them. So from here, the rules are very similar to stock options in regards to capital gains based on the holding period. If you hold them for longer than 1 year, it's long term. If you sell them within that 1 year period of the vest date, then it's short term and it goes on your ordinary income tax. So, same with the stock options. Cost base is $5,000. So, depending on what the price is when you go to sell, that's going to determine whether you have that a gain or a loss, or whether the holding period is the determining factor, or whether it's a short-term capital gains tax or long-term capital gains tax. So it's really the difference between the two is how the vesting occurs and how they are taxed at vest. From the time that the employee gains ownership of these shares, whether it's a stock option where you're purchasing it, or a restricted stock where you're vested and now you have ownership of these shares, going forward, the tax implications are similar between RSUs and stock options, where you're dealing with capital gains taxes from the growth of any of the stock price. So here's an example of a 4-year timeline with an RSU. This doesn't show the tax implications. This shows really kind of what the value is to the employee throughout this timeline. So, the same stock prices here, the hypothetical stock prices that I had in the earlier example. So you're zero when you get those shares granted. Again, no tangible value for the employee until the end of year 1, when 250 shares vest, and now you have $5,000 worth of shares in your ownership and you're taxed on it. Year 2, if the price goes up $25 per share, you have another $250 shares that vest that are worth $6,250. So you're taxed on that amount rather than the $5,000 from year 1. And then now you've got 500 shares of stock valued at $12,500. Now I've got a little asterisk there because the $5,000 or the $6,250 that could be reduced by tax withholding. As I mentioned before, so you might not have 250 shares once the vesting occurs if they sell enough to cover the tax withholding. Value does go down in year 3, because remember I had the stock price going from $25 a share back down to $15 per share, but then it rallies back year 4 and you're back up to $30 per share. Now in this case you've got the 1,000 shares worth $30,000. So in these examples that I've shown here, the restricted stock unit is the better of the two, because in this case, you're not having to front any money to buy shares. You're getting the full award of those 1,000 shares. Whereas with the stock options, you've got to front some of that money based on the grant price in order to get those shares into your ownership. All right. So last section here, just want to go over some key points that we talked about today. Number one is there's a big difference between stock options and restricted stock units. The two were often confused. So, going back to what I said earlier, stock options are really not valuable until stock price gets above the grant price. And when they're granted, sometimes they are granted where the grant price is higher than what the market price is today. So in other words, in that scenario, they're given the employee saying, hey, if you guys can work hard and increase our stock price, these things are going to become valuable for you. Whereas the restricted stock units, you're going to get some value. Just it's going to be determined on whatever the stock price is. So in both of them, both scenarios, it gives the employee a little bit of that accountability on the employee to work hard and help increase the company's profitability and earnings. So therefore, increases the stock price. Number two, I've mentioned this already. It's vital, fully understand the tax implications of each types of compensation plans in regards to stock to avoid any, unwanted or untimely tax liabilities and to maximize that after-tax benefit. So brings me to point three. You want to talk to your professional advisors, your financial planner if you have one, but also your tax advisors to see how this fits in your long-term plan. So this is not something to just kind of let sit and let it do its thing. You want to you look at this periodically and plan these out based on what your tax situation is for any given year. Finally, our team here at Pathfinder, all of our advisors are CFP certified financial planner professionals. So we're experts in stock compensation plans, and we can sit down with you and help you build a plan, and see how this fits into your overall situation. One point, just going back to the differences. One thing just came into my mind. These plans can be awarded by public and private companies. So, private companies can offer these types of compensation plans. It's a little bit more complicated, a little bit more difficult to forecast because private companies only value their stock at certain periods. So trying to put a dollar amount of what the value is of these, whereas if it's a publicly traded company, I could pull up a stock quote and tell you exactly what the value is. So there are some nuances that make it a little bit more difficult for any privately held awards from privately held companies, but definitely want to understand how they work and how they fit into your situation. And those little nuances can cause a big difference in your net after-tax benefit. So anyways, that wraps up the talk for today. Thanks for joining us. If you have any questions, you can give us a call. Here's our contact information, our office line, our website. And again, if you have any questions, feel free to shoot them over to us at info@pathfinderwc.com. Thanks again for listening.